Thanks for tuning into Talking Point. I'm your host, Niraj Shah. And the talking point today are the views of a very, very large money manager, Mr. Hiren Ved. He needs no introduction. And at a time like this, when the markets seem to have climbed the wall of worry and on the cusp of maybe higher highs, it pays to get in the sense of somebody who manages large oodles of money to understand how is he thinking about the equity landscape. Hiren, great having you. Thank you so much for taking the time out today.
Thanks, Niraj, thanks for having me on the show.
Now, the pleasure is entirely ours. So, quick rundown on the talking points that we'll have with Mr. Hiren Ved today. Are we in a cyclical uptick post the RBI pause and possible central banking action globally as well? Will rate sensitives lead the charge in such a scenario? There's a lot of talk about capital goods. Are starting valuations a hindrance for any optimism out there in that space? What is Hiren Ved's mantra on investing in manufacturing, a theme that he coined as a manufacturing renaissance about a year and a half ago? And lastly, the near-term and the medium-term risks to any bullish thesis. Hiren, are you viewing the equity landscape from a prism of global central bankers having paused and a likely U-turn? And is that therefore a positive for even relatively expensive markets like India?
So, Niraj, for sure, I think that, even in this cycle post-COVID, the central bankers poured so much of liquidity into the system. And we saw a solid bounce back from the lows of COVID. I think we've gone into some sort of a post-COVID, post-withdrawal of liquidity scenario. And it now seems like that central banks around the world, including the RBI in India, seem to be now, I would say, more towards the end of the rate hike cycle. Maybe you may have one more or you may not have. It really depends. But I think we are certainly towards the end of the rate hiking cycle, right? And to that extent, yes, I do believe that the markets will see some kind of a bounce. We've seen an improvement in the breadth of the market in the last couple of days. Very seldom have we seen that 3-4 months in a row, the broad markets continue to correct, right? So the damage was not so much at the Nifty level as much as it was for the broader markets. And I think it was a combination of both the central bank hiking cycle, but also the fact that the post-Russia-Ukraine war, we had very high levels of commodity prices, which impacted the EBITDA margins of most non-financial companies, right? Financials obviously took the entire burden of earnings growth in 22-23. But the non-financials really took it on the chin in terms of, a negative operating leverage because of rising logistics costs, rising raw material prices, which now seems to be stabilizing at a lower level from the peak levels, right? So I think going forward from here, you should have a better backdrop with interest rates having peaked and also the challenges in terms of costs for companies also having peaked. So looks like that we are now entering this year with a far better base effect as compared to where we were last year, right? So you had Ps which were at elevated levels and you had a profit margin squeeze. And now I think valuations are much more reasonable than where we started last year. And commodity prices seem to have peaked.
Yeah. And that could be an interesting thing. So, Hiren, tell us, there is a possibility, as you said, of the year-on-year operational metrics looking strong for a bunch of Indian companies. And there is a possible tailwind sentimentally and actually of interest rates in India not moving up further, if anything, at some point of time coming down. Is this a strong trigger for the near-term cyclical uptick for equities, Indian equities?
I would think so. I would think so. I think that there will be still some challenges, but I think on the whole, we seem to be exiting the correction phase of the Indian markets, right?
Okay.
And I think this is the beginning of the next leg of the rally up. That doesn't mean that, it'll all happen tomorrow, but I think we've already started the process for sure.
Interesting. Okay. Hiren, what happens in such a scenario? I mean, typically when interest rate cycles, and I know they used to be longer earlier, this one has been a short one, but it's been a brisk one in terms of the quantum of rate hikes. What happens in such a scenario? Do rate sensitives lead the charge? Autos have this argument of commodity tailwinds in their favor. Real estate, the updates have largely been strong, but the sentiment was bruised because of the rising rates. So does real estate lead the charge? Banks anyways have a strong profit potential as well. What happens in such a scenario?
So, yeah, you're absolutely right. I mean, I think rate sensitives will certainly lead the charge. I also feel, Nikunj, that we may be entering something like a 2003 to 2007 kind of regime, where the kind of sectors that did well, right, were both capex oriented and rate sensitive oriented, right? So if you go back and reminisce about 2003 to 2007, the kind of sectors that did well were infrastructure, real estate, autos, EPC companies, power ancillaries. A lot of that kind of businesses did phenomenally well. And yes, there is always a change in leadership because, 2003-07 was a different era. A lot of those companies didn't survive post the bust in 2008-9, but many did. And those that survived but didn't go anywhere in the last 10 years are now likely to start doing again, right? So I think very similar kind of sectors like cap goods, power ancillaries, EPC, infrastructure, auto and auto ancillaries, cement, real estate, defense, mid-cap IT, and maybe a few select consumer discretionary companies should do well. Because back then in 2003 to 2007, our per capita was still less than 1/3 of where we are today, right?
Yeah.
So wherever there is a scope for premiumization and where there isn't too much of a disruption, I think you will see in discretionary consumption, there should be a secular trend going forward from here as well. So I think, to me, it looks like it will look and sound a little bit like 2003 to 2007, not just in the near term, but also in the slightly medium to long term as well, right? Also, if you look at, this government, the focus has been that they have not chosen to pump prim the economy by giving money in the hands of people and raising demand, right? So despite COVID, we didn't see any GST tax cuts. We didn't see any significant cuts in fuel taxes. But what we saw, on the other hand, was a significant bump up in capex and infrastructure spending across railways, roads, ports, renewable energy, and so on and so forth, right? So it's very clear that this government is focused on infra spending, and at the same time, they are also focused on incentivizing manufacturing in a big way across sectors, and the whole PLI incentive schemes across 14, 15 sectors. They keep adding new sectors to that. And given the fact that the post-COVID world is re-globalizing as opposed to deglobalizing, where a lot of countries are saying that, we need to manufacture some of the stuff internally, or we need to diversify away from China. We can't have all our eggs in one basket, right? So whether you call it China plus one, Europe plus one. So the entire manufacturing complex, infrastructure, renewable energy, cap goods, autos, auto ancillary, real estate, I mean, all of that will be back in the reckoning, in my view.
Wow, that's an interesting one. Comparing it to 2003, 2007 as well, it's really interesting. So I have three follow-ups to this answer, Hiren. One planned and two unplanned.
Sure.
The planned one first, and that is the manufacturing piece. Now, I remember you wrote a small piece for BQ Prime. You spoke about it extensively in an interview about a year and a half ago about the manufacturing renaissance. It's moved some legs as well. And at that point of time, people believe that cap goods and anything that supplies to manufacturing could also be a great play. My question to you is, in an upcycle, the EBITDA of these companies move very fast, but
Yes.
starting valuations are, I mean, say for an L&T maybe, starting valuations for the ABBs, the Siemens, etc. of the world are very rich. Is that a hindrance, or do you think the cycle takes care of it?
So you're right, absolutely, Niraj, that many of the cap goods company valuations have gone up. But we have to understand that we are, to my mind, in the beginning of a cycle, right? So typically what happens is that the valuations preempt the improvement in fundamentals, right? And valuations of cap goods is a little bit counter-cyclical, right? They always appear expensive at the beginning of the cycle because
Okay.
the market cap goes up as order books go up and profits follow, right? So earnings is a lagging indicator, not a leading indicator. What the leading indicator is usually the order books. And if you pick up and look at most of the cap good companies, where they are sitting today compared to 2-3 years, their order books are at their peak. But if you take a slightly longer term horizon, right? I mean, they've not even crossed their profitability that they had crossed during last time when they peaked, and various companies peaked between 2010 and 2012. And after that, it was just a one-way down. So you had a decade of a downturn, and you've just having 1.5 year of an upturn in cap goods. To me, it's just the beginning. So it's quite possible that some of them might just go sideways for some time. There might be some time correction where the valuations have caught up very quickly. But if we believe, and I certainly do believe, that this cycle is just about starting, then I think they'll go from strength to strength with intermediate periods of correction, consolidation, time correction, and all of that, right? Let's not forget, even a stock like ABB corrected from its peak by 20-25%, and now it's back to its peak, right? So I think, yes, optically, in some of these, the starting valuations may look very, very expensive. But if we believe that we are in the beginning of the cycle, the starting part of the cycle, we've just in the first 1.5-2 years of the cycle, which may be a relatively longer cycle, then I think we have a long way to go.
Okay. Some people make this argument about order books for defense. I'm moving tracks a little bit, but using the defense and the order book argument here, the defense companies always have had a very strong order book, but because the government was never able to or didn't go out and necessarily put in the money every single year for execution, the order books remained, but the annual execution was never that strong that there'll be multiple years of an earnings uptick. Is this time different, and why so?
So I think it's very clear that yes, for example, if you look at this budget itself, right, people were very excited that, okay, let's see what the defense number is likely to be, but that wasn't like significantly greater. In fact, it was more flattish than anything else, and some of the defense stocks corrected, right, but they are back up again, right, and the reason is that it is not so much about what the defense outlay is, but the fact that today a significant amount of that defense outlay is coming to domestic companies, right, as opposed to imports. But yes, we must be careful that unlike in short cycle private sector capital goods companies, the cycles of execution in defense are much longer, right? And sometimes it does take time. But I think the post COVID, post Ukraine, Russia war kind of a situation has forced the government to start thinking very strongly about involving Indian companies, both the public sector as well as the private sector, in the defense manufacturing opportunity, right? They look at this as one way of getting manufacturing off the ground, is to give more and more orders to domestic companies, whether it be public sector or private sector. But yes, the cycles are longer. But I think that this is a trend, to my mind, which is irreversible. You look at, we're now starting to buy, domestic aircraft, right? I mean, and I also believe that even on the commercial side, where, the private sector is ordering commercial aircraft, those companies are starting to, the Boeings and the Airbuses of the world are starting to source more and more of their supply chain from India, as opposed to what they were doing earlier. To me, it's a reality.
Yeah, no, it's a fair point. And I think both the Airbus commentary, both for China as well as India, shows that they are probably wanting to even implement the manufacturing out of those countries per se. So that's an interesting point, Hiren. Thank you for that. Hiren, just trying to understand, how does the other aspect now, and which is the point that you mentioned in your earlier answer, which is about the per capita rising and what is that to discretionary. Now, do you reckon India will follow the typical Asian model, wherein all forms of discretionary, typically over a $2,300, $2,400 per capita, will tend to do well? What is your favorite theme here? Because it's a very wide bucket. And in India now, we are seeing even FMCG companies moving to premiumization to take advantage of that. So how are you thinking through this?
Yeah, I mean, it's interesting at a very broad secular level. While we talk about the $2,300 per capita, but there are many mini Indias within one big India.
Yeah.
So there is about 80 to 100 million population, which consumes like a $8,000-10,000 per capita income country. There is the next 80 to 100 million that consumes like a $3,000-4,000 per capita country, and then the rest of it is really below, right? So there is demand at every price point for sure. But I think what we have seen post-COVID is that while the trend of premiumization was always there, but I think it got accelerated post-COVID, right? As people started to focus more on quality, started to focus more on health and well-being. And I think that trend will only accelerate. But within the consumption, we have to be careful that there will also be disruption, right? Especially, we are starting to see that, for example, in the FMCG space, where now, unlike in the past, the big retailers are increasing their footprint massively. They were still relatively small, and therefore, the FMCG companies were really benefiting from the deep distribution that they had built over decades, going down to every village level and having a product available in sachets with small pricing, so that they could cater to the people at the lowest level, right? But now there is, and that will still continue to be a competitive advantage, but there is beginning to be competition, where, for example, Reliance has already started talking about private labels in FMCG products, which they can now start retailing through their stores. There is today far more accessibility for products on the internet platforms and the e-commerce platforms, and now ONDC is also a reality. It'll take time. It's not going to happen overnight. But I think the absolute stranglehold that the traditional FMCG companies had on this market is obviously starting to defray a little bit. Because today, you could have an upstart brand which can advertise on social media, sell on e-commerce platforms, and get the product delivered to any pin code, right? With the kind of logistics infrastructure that is already in place. So if you hear people like Amazon or Myntra, for example, they tell you that a lot of their incremental orders are coming from B and C towns and, smaller towns, because, those consumers didn't have those retail shops back, because probably it was not economical to set up, whether it is apparels or whether it is whatever. But today, it's easier with this kind of e-commerce infrastructure which has been set up. And this is also to some extent, a result of the fantastic work that India has done on its digital ecosystem, right? The whole payment system that we've created through UPI and linking it to the bank accounts, and the work that has gone by the big retailers to build, and also in the post-GST world, to build warehouses everywhere around the world and connect the last mile to the last consumer, is revolutionary, right? So I think we have to be careful that while brands will play an important role, but there is going to be more competition today than what it was 10, 15 years ago, right? But I think there are certain categories, for example, liquor, right? Where both in beer and in spirits, you still have the largest player who has a 50% plus market share. And it's such a difficult industry, right? You can't sell on an e-commerce platform because regulations don't allow you to do that, right? You still need a very, very assiduous distribution network. It's like selling in 28 states is like selling in 28 countries, right? So those are less likely to be disrupted. Though they also, to some extent, got disrupted because there were new brands like Bira and, a lot of the Indian brands now in gin and vodka are doing exceedingly well. You have a couple of our now winery companies which are starting to do certainly well. So there is more competition there, but I think wherever there is premiumization, right? I think there is an opportunity as incomes rise and more is going to be available. So you'll have to pick and choose within those sectors. You're absolutely right. It's a very wide basket.
So what have you chosen, Hiren? I'm just trying to understand. Have you chosen hotels? Have you chosen liquor companies? Have you chosen QSRs? Have you chosen AC companies? What have you chosen?
So we have, I think we've had investments in liquor companies for a while, right? I think the premiumization trend is very, very solid. We do love the QSR space as well. And I think that the QSR space will grow over the next couple. Just look around you and see how many cafes have sprung up now. There were only 2 QSR companies 5 years ago, McDonald's and Domino's Pizza. Now there are many more, right? So I think eating habits have changed. More importantly, with the advent of food delivery companies like Swiggy and Zomato, means that QSRs have both engines for growth. You could either order in or you could dine in, right? And ordering in was not possible earlier. But today it's absolutely possible. And suddenly you feel small companies in biryani, in, a lot of food categories, which Indians love. So beyond the global categories like pizza and
The burgers, yeah.
and burgers, you also now have Indian food, which Indians love, which can, travel through the food delivery system, ecosystem, which has been built, right? So I think QSRs is interesting. Liquor is interesting. And I think organized retailing is also interesting because, uh, slowly and steadily, I think they're increasing their footprint, and they're increasing the amount of SKUs that they are willing to. So I think it's going to be interesting. And you mentioned hotels. I do agree. I think, the time again for, I think hotels and hospitals, though they are unrelated in many sense, but I think the model is now changing, where there is less investment in greenfield, but there is more investment in buying existing assets and using your brand and your management contracts to drive revenue, right? So, and if you look at Indian hotels or many of these, right, they're not building, they are building new hotels, but they're not building as many new hotels as much as they are gobbling up existing, standalone hotels and doing management contracts, right? So it's a less capital intensive way of growing. And also aspirations, right? People are now traveling within the country far more than what they were thanks to COVID. They are rediscovering India.
Yeah.
Flights are full, airports are full, and hotels are full, right? So I think that's all plays into the discretionary consumption kind of theme. So and similar to hospitals as well. I mean, like, it's so difficult to build a greenfield hospital with the number of permits that you need. But what the hotels did, the hospital chains are doing now, right? They're doing brownfield, or they are buying existing assets, standalone 1, 2, hospitals, and making it a part of a big chain, and using their infrastructure and brand and management expertise to increase their footprint.
Wow. Each of your answers gives me 4 questions. I can continue for an hour, Hiren, but I understand there is paucity of time. Very quickly, Hiren, sorry, I know I've extended our appointment, but just very quickly, one last thing. So you spoke of a cycle like 2003, 2007. You spoke of the number of options available. Still, portfolio allocation would mean that you allocate the right amount of capital to the highest bet, so on and so forth. What is Hiren Ved's top long-term bet in terms of allocation, or in terms of conviction, or a mixture of both? I mean, the theme, I mean.
So I think financials definitely was a big area. However, I believe that for banks, which has been a great area for everybody to invest in, I think the best of the parameters for banks may be behind us.
Okay.
You had, especially in 22, 23, you had the best NIMs. You had very strong credit growth. You had very low credit costs. And I'm not saying that won't continue into 23, 24. But I think incrementally going forward, we may have to look for other niches within financials to make absolute alpha. Because I think beyond a point, to my mind, the sort of the big financials in which everybody is invested in, including ourselves, is likely to be market performance. So I think a lot of our incremental bets that we will take across a lot of the themes that I spoke about will to some extent be funded by us taking money off the table from some of those large financials, right? And it'll happen over a period of time. I think increasingly we have taken bets in capital goods, the ABBs and the L&Ts of the world, but also smaller companies there, autos, auto ancillaries. And I think incrementally we will see a lot more allocations in the portfolio to these names that I mentioned, whether it was cap goods, EPC, infra. We were bullish on mid-cap IT, though that's a big name, but within mid-cap IT, we were very bullish on the ER&D companies. We continue to be bullish on them. We think they are still in a structural growth phase. I think there is an opportunity there as well. And then in a few select consumer discretionary names, right? So I think over the next 2 years, you will see a slight shift more in the portfolio towards the same themes of manufacturing, cap goods, auto ancillaries, mid-cap IT, and a few select discretionary consumption is where we will be. And then in pharma, you have to be very bottoms up. Yeah. So, you just pick a name which you think will do well, or in specialty chemicals, or some of these areas where there will be secular growth going forward. But this is broadly how we look at the portfolio building up over a period of time.
You give me a better answer than I was hoping for, Hiren. Thank you so much for that. Really appreciate your time today, and all the best for a very happy investing period over the next 3 to 5 years.
Thanks, Niraj. Thanks.
The pleasure was ours, and viewers, thanks for tuning in.